Today, we're doing a complete breakdown of international financial reporting standards versus U.S. generally accepted accounting principles versus Indian accounting standard inventory accounting. Full comparison plus interview questions. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying international financial reporting standards, Indian accounting standard, ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Did you know? Companies can manipulate profits by up to 10% by tweaking inventory valuations. This disguised profitability was once a subtle trick in accounting. With international financial reporting standards, U.S. generally accepted accounting principles, and Indian accounting standard, though, the game changed. Each framework offers unique solutions to standardized value reporting. After this section, you'll grasp how these standards tackled inconsistencies and ensured comparability. Inventory accounting standards emerged to tackle profit manipulation through inventory valuation. Before their introduction, companies had too much freedom, allowing inflated earnings. International financial reporting standards, U.S. generally accepted accounting principles, and Indian accounting standard each provide a framework that enforces uniformity. By mandating specific cost flow assumptions, they prevent misleading financials, ensuring consistency and comparability across markets. This transparency not only curbs manipulation, but also enhances investor trust, vital for fair market valuation. International financial reporting standards is utilized by over 140 countries, impacting firms globally. U.S. generally accepted accounting principles governs all U.S. publicly traded companies, while Indian accounting standard became mandatory in India for large companies in 2016. Each framework focuses on a critical principle, valuing inventory at the lower of cost or net realizable value. This ensures that companies reflect the true economic value of their inventory, preventing overvaluation and enhancing reliability in financial reporting. Understanding the inventory measurement model is crucial in interviews. International financial reporting standards prohibits LIFO, favoring FIFO and weighted average methods, ensuring consistent cost assignment. U.S. generally accepted accounting principles, however, provides flexibility by allowing LIFO, FIFO, and weighted average. Indian accounting standard mirrors international financial reporting standards, focusing on FIFO and weighted average, excluding LIFO. These methods determine how inventory costs affect profit margins and financial comparisons, crucial for accurate reporting and strategic business decisions. Understanding the scope of inventory accounting standards is crucial because candidates often forget that real estate held for investment is not covered by these standards, a classic interview trap. Misunderstanding scope can lead to errors in financial reporting. Knowing what's included and excluded ensures compliance and accuracy in inventory valuation. The standard applies to items like raw materials, work in progress, and finished goods. Each plays a role in manufacturing and sales processes. For instance, raw materials turn into work in progress and eventually finished goods, impacting cost of goods sold and profitability. Remember, even spare parts for production are included, ensuring accurate financial reflection. Understanding exclusions helps avoid misclassification. Financial instruments aren't inventory, they follow distinct financial standards. Biological assets like livestock require unique valuation methods, excluding them from inventory. Similarly, real estate held for investment isn't inventory, as it's treated as an investment. Construction in progress for real estate also doesn't qualify, aligning with real estate development standards. Recognizing these distinctions is key to accurate financial reporting. Inventory is anything available for sale or use in production. For example, a car manufacturer's inventory includes vehicles ready to sell and parts used in assembly. Proper classification impacts asset valuation and financial reporting. Understanding what counts as inventory ensures accurate cost accounting and resource allocation. crucial for manufacturing and retail sectors. Cost includes all expenses directly tied to getting inventory ready and available. This involves purchase price, transportation, and storage costs. For instance, shipping fees for raw materials are included in their cost. Understanding cost ensures accurate inventory valuation, influencing profit margins and financial health. Excluding abnormal wastage helps reflect realistic production and storage costs. Scope edge cases test your understanding of inventory application. Inventory held for future projects, used as collateral, or damaged awaiting claims presents unique challenges. For instance, goods in transit at year-end count if risks and rewards have transferred. Knowing these nuances ensures proper classification and valuation, critical during audits and reporting. Picture a retail giant with billions in stock. Accurately tracking and valuing this inventory affects profits and taxes directly. The inventory measurement model ensures that companies reflect the true costs and value of their inventory, preventing financial misstatements and aiding strategic decisions. Imagine a tech company launching a new smartphone. The inventory model helps determine stock value, from procurement to sale. It assures investors of accurate, trustable figures by standardizing inventory accounting. This is crucial for decisions like pricing strategies and cost control, directly impacting profitability. Identifying inventory items isn't just checking what's in the warehouse. It's about recognizing all components, raw materials, parts, and finished products. For example, Acme Corporation lists $500,000 in raw materials, ensuring everything is counted. Missing such details could skew financials, impacting decisions. International financial reporting standards mandates clarity here to avoid misstatement. When determining inventory cost, capture every dollar spent, not just the purchase price, but shipping and duties too. Tech Innovators, for instance, tallies $1.2 million for imported parts. Miss any of these, and your costs look lower than reality. Remember, U.S. generally accepted accounting principles excludes abnormal waste from these calculations. Choosing your inventory valuation method isn't just a formality. It affects taxes and cash flow. Retailer XYZ uses FIFO, showing $3 million in inventory amid rising prices. Inconsistency here can lead to financial volatility. Note, International Financial Reporting Standards rules out LIFO, so your choice narrows to FIFO or weighted average. Assessing net realizable value means predicting sales prices and deducting costs. Take Tech Solutions. They appraise obsolete gadgets at $200,000. Missing market shifts here can lead to overvalued inventory. Under ASC, this assessment happens every reporting date to ensure assets aren't overstated. Recording inventory transactions requires precision. It's about entering purchases, sales, and adjustments correctly. Global Exports logs a $750,000 inventory buy, ensuring all data is traceable. Misdated entries can lead to discrepancies in financials. Indian accounting standard insists on meticulous records to uphold accuracy and reliability. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. International financial reporting standards and U.S. generally accepted accounting principles have distinct approaches to inventory valuation. Understanding these differences means recognizing which costs to include and the impact on financial statements. Explore how these frameworks guide companies in reporting inventory accurately. Initial recognition involves capturing inventory when control transfers. Under international financial reporting standards, consider costs like purchase price and duties, excluding discounts. U.S. generally accepted accounting principles mirrors these principles, but clarifies exclusions like storage costs. Indian accounting standard also requires initial measurement at cost. Imagine acquiring $100,000 in goods. Recognition aligns with these standards to ensure asset accuracy. Once inventory is on the books, its valuation can change. International Financial Reporting Standards triggers remeasurement when net realizable value falls below cost. U.S. Generally Accepted Accounting Principles uses a similar approach, focusing on market values. Indian Accounting Standard aligns with International Financial Reporting Standards. Imagine inventory initially valued at $500,000, now assessed at $450,000. Adjustments ensure financial statements reflect true value. Proper presentation of inventory affects the overall financial snapshot. It sits under current assets on the balance sheet, influencing liquidity ratios. Cost of goods sold, derived from inventory, appears on the income statement, dictating gross margin. Notes detail accounting policies, ensuring transparency. Consider a company with $2 million in inventory. Misclassification can distort financial health. Key disclosures paint a clear picture of inventory's role in financial health. Accounting policies and valuation methods must be transparent, allowing investors to gauge asset quality. Breakdown by category, like raw materials, showcases efficiency. Write-downs to net realizable value hint at market impacts. Pledged inventories reveal potential obligations. For instance, a $300,000 inventory write-down signals significant market shifts. Imagine a CFO's challenge, evaluating a $10 million inventory purchase. Using International Financial Reporting Standards, a write-down may hit net income by $200,000, reshaping profit views. Under U.S. Generally Accepted Accounting Principles, opting for LIFO could cut taxable income, boosting cash flow. Indian Accounting Standard aligns with International Financial Reporting Standards, focusing on net realizable value. Each choice impacts financial presentations, vital for strategic planning. Recruiters always ask, what changes if your client follows International Financial Reporting Standards instead of U.S. Generally Accepted Accounting Principles? Here is exactly where they split. Understanding these differences could be the edge you need in a job interview. The right framework could change your client's inventory valuation by millions, affecting everything from taxes to investor perceptions. Scope defines how frameworks apply to different scenarios. International Financial Reporting Standards and Indian Accounting Standard are principles-based, providing flexibility but demanding judgment. U.S. Generally Accepted Accounting Principles is rule-based, which can be restrictive but provides clarity. Each impacts inventory valuation differently, especially evident in the acceptance of LIFO under U.S. Generally Accepted Accounting Principles, contrasting with the prohibition under International Financial Reporting Standards and Indian Accounting Standard. Recognition is about when inventory impacts the balance sheet. International Financial Reporting Standards and Indian Accounting Standard emphasize control transfer, aligning recognition with economic reality. U.S. Generally Accepted Accounting Principles focuses on risk and reward transfer. This difference can lead to earlier or delayed recognition, impacting earnings and management decisions, particularly in industries with complex supply chains. Measurement dictates inventory valuation on financial statements. International Financial Reporting Standards and Indian Accounting Standard disallow LIFO, which is permissible under U.S. Generally Accepted Accounting Principles, potentially reducing taxes. While International Financial Reporting Standards and Indian Accounting Standard allow inventory write-down reversals, U.S. Generally Accepted Accounting Principles prohibits them. This key difference can lead to varying financial outcomes in recessionary periods or recovering markets. Presentation and disclosure ensure transparent financial reporting. International Financial Reporting Standards and Indian Accounting Standard emphasize narrative disclosures, fostering a comprehensive understanding. U.S. Generally Accepted Accounting Principles prescriptive style demands detailed line items, providing clarity but limiting managerial discretion. These differences can significantly impact how investors perceive a company's inventory strategy and financial health. Being prepared for inventory-related interview questions means understanding these key points. LIFO's impact on taxes under U.S. generally accepted accounting principles, the permissibility of write-down reversals in International Financial Reporting Standards and Indian Accounting Standard, and how measurement and disclosures differ. Mastering these nuances could be the difference between a confident answer and getting stumped. Meridian Corporation, a global manufacturing powerhouse, embarks on a journey to optimize its inventory management. As they procure $1.2 million in raw materials, we'll track every accounting move under International Financial Reporting Standards, U.S. Generally Accepted Accounting Principles, and Indian Accounting Standard. See how these frameworks shape Meridian's financial landscape. Recording this entry under all three frameworks ensures the inventory is accurately reflected in the balance sheet. Recognizing the inventory at cost, in this case, $1.2 million, aligns with the historical cost principle. This entry increases assets and liabilities equally, maintaining the accounting equation's balance. Recording conversion costs under International Financial Reporting Standards, U.S. Generally Accepted Accounting Principles, and Indian Accounting Standard ensures that the inventory reflects total manufacturing costs. By capitalizing these costs into work-in-process inventory, Meridian's financials accurately represent the resources tied up in production. This entry reflects the commitment of cash or payable resources to enhance inventory value. This entry under all standards signifies the completion of production. By transferring costs to finished goods inventory, Meridian aligns with the matching principle, ensuring that costs flow through the income statement as revenues are recognized. This prepares the inventory for sale, impacting future revenue recognition. Recording sales and cost of goods sold aligns with revenue recognition standards, ensuring revenue and expenses match. By recognizing revenue and corresponding expenses, Meridian's financial statements reflect true profitability. The $500,000 gross profit showcases effective inventory management and sales strategies. Valuation write-downs under International Financial Reporting Standards, U.S. Generally Accepted Accounting Principles, and Indian Accounting Standard ensure inventories aren't overstated. By adjusting to net realizable value, Meridian protects future profits from inflated asset valuations. This conservative approach reflects current market realities, safeguarding the balance sheet integrity. Disposing obsolete inventory is crucial under all frameworks to avoid overstatement of asset values. By recording a $50,000 loss, Meridian ensures transparency and accuracy in financial reporting, reflecting true operational efficiency and asset management. Year-end adjustments are vital for accurate financial reporting. Reflecting inventory shrinkage ensures the balance sheet mirrors real inventory levels, maintaining compliance with International Financial Reporting Standards, U.S. Generally Accepted Accounting Principles, and Indian Accounting Standard. This transparency is crucial for stakeholders evaluating Meridian's operational efficiency and inventory control. Revaluing inventory under changing market conditions ensures financial statements reflect current asset values. Recognizing a $70,000 revaluation gain under appropriate standards strengthens Meridian's balance sheet, showcasing improved asset quality and readiness for future opportunities. Every Big Four and investment bank interview on International Financial Reporting Standards versus U.S. Generally Accepted Accounting Principles versus Indian Accounting Standard Inventory Accounting full comparison plus interview questions follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. LIFO, last in, first out, assumes the latest inventory is sold first, while FIFO, first in, first out, assumes older inventory is sold first. LIFO can result in lower taxes when prices rise, as it matches higher costs against current revenues. However, LIFO is not allowed under International Financial Reporting Standards and Indian Accounting Standard, only U.S. Generally Accepted Accounting Principles. Remember, LIFO can distort balance sheet inventory values. Inventory write-down occurs when the market value of inventory falls below its cost, ensuring financial statements reflect true asset values. This write-down reduces both inventory and net income, impacting profitability metrics. Under International Financial Reporting Standards and Indian Accounting Standard, write-downs can be reversed if market conditions improve, unlike U.S. generally accepted accounting principles. Always check for potential reversals under International Financial Reporting Standards to avoid misstating asset values. The inventory should be recorded at net cost, reflecting the discount. If the purchase price is $100,000 with a $10,000 discount, record $90,000 as inventory. This aligns with the cost principle, ensuring that the inventory is not overstated. Misrecording discounts may lead to inflated inventory values and misstated earnings. Both International Financial Reporting Standards and Indian Accounting Standard require inventory to be measured at the lower of cost and net realizable value. However, specific guidance on cost formulas like FIFO or weighted average is more detailed in Indian Accounting Standard. Ensure to apply the right guidance for regional compliance. Misunderstanding these nuances can lead to compliance issues. Inventory write-downs decrease total inventory and increase cost of goods sold, reducing net income. Under International Financial Reporting Standards and Indian Accounting Standard, write-downs can be reversed if market conditions improve, unlike U.S. generally accepted accounting principles. Always consider potential reversals under International Financial Reporting Standards for better asset and income accuracy. Misjudging write-down impacts can skew profitability analysis. International Financial Reporting Standards and Indian Accounting Standard prohibit LIFO, favoring FIFO and weighted average cost. U.S. generally accepted accounting principles allows LIFO, which can be beneficial for tax purposes during inflation. Understanding these differences is crucial for correct financial reporting and strategic inventory management. Misapplying methods can lead to compliance risks and financial distortions. Under FIFO, the ending inventory consists of the newest 20 units, valued at $10 each, totaling $200. FIFO ensures that older costs are matched with revenues, reflecting current costs and ending inventory. Misapplying FIFO can lead to incorrect cost allocations and profit reporting. Always align inventory valuation with sales for accuracy. Storage costs are generally not included in inventory costs unless necessary for production. This distinction is critical under International Financial Reporting Standards and Indian Accounting Standard. Misclassification can misstate assets and cost of sales. Often, candidates mistakenly allocate all storage costs, skewing financial records. Accurately allocate costs to reflect true production expenses. Inventory disclosures must detail valuation methods, cost formulas, and any write-downs. International Financial Reporting Standards and Indian Accounting Standard require more detailed breakdowns than U.S. generally accepted accounting principles, including reversals of write-downs. This transparency aids in evaluating management's inventory strategy. Candidates often overlook the required granularity, leading to incomplete disclosures. Always verify compliance with relevant standards. Understanding the basics of inventory accounting means knowing how International Financial Reporting Standards, U.S. generally accepted accounting principles, and Indian Accounting Standard define and scope inventories. Each framework ensures transparency and comparability for raw materials, work in progress, and finished goods. The core principle across them is valuing inventories at the lower of cost and net realizable value, highlighting the importance of accurate reporting in financial statements globally. Inventory measurement is critical for accurate financial reporting. For International Financial Reporting Standards, Indian Accounting Standard, and U.S. generally accepted accounting principles, the lower of cost or net realizable value is key. While FIFO and weighted average methods are common across standards, U.S. generally accepted accounting principles uniquely allows LIFO. Write-downs occur when inventory costs surpass net realizable value, ensuring inventories reflect true economic value. Understanding these methods helps in assessing a firm's profitability and financial health. When navigating interviews in finance, knowing key differences is crucial. Understand how LIFO impacts profit under U.S. generally accepted accounting principles, not allowed in international financial reporting standards. Be prepared to discuss disclosure nuances, like LIFO reserves, and the implications of impairment reversals. Grasping consistency in cost methods and recognizing market versus NRV differences ensures you're ready for tricky questions. These insights can set you apart as a knowledgeable candidate. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.